see you all after a
Good evening, ma'am.
Good evening. Yes, it's summer break, and then thank you for joining us. Maybe more. Some of you are on vacation, and then some of you are wherever you are joining from there. Thank you so much for joining us today. Most of you are familiar to WEL. If you are new, Women Educators League, which was started in the year 2019. Women educators who are actually increasing in numbers across the globe to support them in various ways. Be it in terms of professional education, or wanting to pursue their higher education, or wanting to relocate to a different country, in terms of wanting to for a new experience, on a sabbatical, to do research, any kind of a support. Women Educators League, we do support. I request all of you to kindly mute yourself, please. Thank you. Appreciate your support. Thank you. So today, today's topic in this session, we have been doing Challenge the Change series. So now we have come back with the series on empowering educators. Whoever is there, can you mute yourself, please? Thank you. Yeah. So today we are here with challenge empowering the educators, and this is a topic which is very close to all of us, which is very vital in everybody's life. Money, finance, and especially as educators, we all know how tough it is, and then we are definitely the least paid kind of a sector in the industry. You compare to any industry, we are the least paid. However, even the international schools, we are the least paid. Even if we have to talk good about it across the industries, if we have to compare, we are the least paid. But we do have ambitions, we do have families, and then we always want to save and then multiply the little money that we have. So how do we do that? And we always have the fear of, can I trust the right people? How do I go about making it? Yeah, I have absolutely no clue about doing it. These are some of the questions which are, haunting us. And whenever I interact with educators, and these are the questions which comes back to us. And today, we have amongst us Mr. Jaideep Tibrewala, a seasoned person in the industry from the finance sector, and who is a good friend of mine. In the last 10 years, we have been associated with each other. So we know each other the last 10 years, and he is here to empower us. I requested him, Jaideep, can we do a session for the teachers on making them understand what investment is all about? Can we actually make investments in mutual funds? Because most of the teachers, whenever I do a session, they keep asking, no, we do to create an asset or to invest in mutual funds, we need to have a lot of money, but I don't have that. How do we go about it? Now, these were the questions which I threw to Mr. Jaideep, and then Jaideep happily agreed. I said, come on, Dr. Malti, I'll be happy to do it. So here the floor is yours, Mr. Jaideep. Before I pass on the podium to him, I wanted to introduce him. Mr. Jaideep is currently the head of product at Glide Invest, an online wealth management platform that currently curates and distributes direct plans of mutual funds for investors across India. Prior to Glide, Jaideep was the co-founder and the CTO at Clear Funds, which was acquired by MobiWik, and the founder of Loan Munch. As of 2021, he has been in the fintech space for over 5 years. Jaideep has also spent 8 years with a large business conglomerate in Mumbai, and a similar time in tech consulting companies in Chicago, USA. And then Jaideep has an MBA from Chicago Booth, and then bachelor's in CS from the University of Wisconsin, Madison. Jaideep actively mentors young startups in their product and tech journeys, while he himself builds his expertise with more complex problems of scale to be solved. We are happy to have someone of your caliber, Jaideep, and then the floor is all yours. We are waiting to listen to you. Thank you.
So thank you so much, Dr. Malti, for the kind introduction. And yes, it's been about over 10 years that we've known each other, and I'm happy to reconnect with you and help in whatever way I can. So education space has been very close to me. I've known Dr. Malti for 10 years. My wife is actually a teacher. So there is the dual connect there. So I wanted to reach out to the educators in this space and see how I can help them think about investing. I think more important aspect before you even dive into what you should invest, how you should invest, is a whole aspect of psychology of investing and how you should go about thinking about it. So I hope that in this session today, I'm able to help you with some simple rules, simple things to consider, simple things to follow. What I'd like to do is, talk about I have a couple of slides to present. I'd like to open it up to questions at the end of that presentation. In the middle, if you have any questions, please put them on the chat, and I'll work with Dr. Malti to kind of address them as we end the conversation. And the idea is I'll try to make this a little bit interactive. And I've done my best to keep it at a very minimal and simplistic level so that everyone can understand and everyone can relate to what I'm saying and kind of relate to it with their own life experiences, right? So why don't we get started? Right, just give me a second here. So let's start with a simple story. This is a recent client of mine. Obviously, names and actual photos have been kept away for client confidentiality. But let's look at her story, right? Puja Mehta. Puja Mehta is a 27-year-old aspiring teacher. She's been teaching about for the last 3 to 4 years. Now that she has actually settled down in her school, she has a strong desire to invest and create wealth, right? For her, the money that she has earned in the school is very important. It's precious to her. She has heard of a lot of people who've made mistakes. So what are the concerns she has, right? She's confused. The investing world is very complex. There are lots of products, lots of things to go to. If you go to a bank, banks try to push certain things to you. If you go to an advisor tries to push something to you, you're not sure whether you can trust that advisor or not. Again, paralyzed with thousands of choices, no clue where to begin, right? Where should I begin? How should I start thinking about it? Maybe her parents have done investing in a very traditional way. She may not want to follow it because she thinks that the growth in those traditional investments is not that great. She wants to do something better. There are a lot of new products out there which can probably give her a better result. So a lot of questions out there. And finally, the biggest question, right, which everyone has, especially when you're dealing with money: who do I trust and why should I trust that person? Right? So, underlying statement that she had to us is, I'm afraid of being misled into losing my money. The money is very precious to her, and she wants to make sure that she's doing it the right way. So, when it comes down to the basics of investing, there are a lot of needs that a person has, and there are a lot of fears that the person has also, right? So if I'm sure many of you are familiar with Maslow's hierarchy, but if you convert Maslow's hierarchy into financial needs, right, the most basic needs that you have to cover for are your daily and emergency needs, your food, your clothing, your transportation, and your daily life that you need to cover. The second thing that you need to cover is, of course, your life and medical insurance. Is the most important because you never know when a situation hits you when expenses related to medicine come into play. And then short-term goals, like a vacation or something of that sort, maybe then a medium-term goal. And at the top of the pyramid comes a long-term goal, right? But the long-term goal has a long-term horizon. How do you start thinking about and planning for a long-term goal today when generally in life you're struggling with the first two layers itself, right? The first two layers, which is your daily needs and your medical needs, right? So what are some common financial fears that people have? And I would encourage the people who are listening to this to leave a note in the chat to say to share what some of their fears are, right? Very, very common fear that I hear from everyone, even some of the people in my own team, right, is that my salary is not high enough to make a difference to my wealth. I'm going to come back to that statement once I finish these, right? So very, very common statement, especially for new investors, especially for beginners, especially for a lot of people in the education space. Second one, as I said, my spouse or my father invests for me, so I don't really need to worry about it. A lot of times there are people who just leave it to their spouse or father, and then when they actually have to take it over, or when they actually have to figure out what has happened, they don't know where the money is. They don't know how the money has been invested. They don't know how the money got spent sometimes, right? Third one is, I don't understand investing, too many products, too complex. Yes, I will go over another slide where you'll see how many products and how complex it can be, right? Fourth one, I don't trust an advisor. I don't trust my broker. I don't trust my bankers. Bankers try to push products to us. I don't know if they're the right products for me. And very often people will say, what about fixed deposits, right? Fixed deposits are easy. I know that I'll get, based on today's interest rate, 6% returns on them. They're safe, they're guaranteed. Why don't I just do FDs? But everyone knows, right, that by investing in FDs, well, yes, FDs are good. They're a good product to invest in. But will it help you really gain your financial independence and help your finances grow? That's always questionable, right? Because of something called inflation, and which I'll get to next. And finally, right, what if I make a mistake? My investments don't perform. What if I've selected the wrong product? Again, a function of too many products being out there and not knowing enough about the products to be able to invest in the right product. So those are common fears that people have. Again, as I said, please share in the chat box if there are some other fears that you have. I'd love to hear from the people who are out here and also talk about them towards the end of the presentation. I'll go back to the first point. My salary is not high enough to make a difference to my wealth. Yes, that's a point which a lot of young people and also a lot of people who have just started earning or who are just beginning their career or maybe in the first few years of their career feel. But I'll give you a simple example. I had one of my own colleagues or someone on my team who I hired who came to me and asked me the same question that I want to start investing. Can you help me? So I said, yeah, sure. Let me help you. I gave him some suggestions. And I said, and then the first question he had was, Kitna deti hai? How much will I get? Right. And I was like, don't worry about how much kitna deti hai, how much will I get? That will come later. The more important part is for you to build a habit of investing. So he didn't invest, right? And it's been 12 months since the person did not invest. Yes, if you invest 100 rupees or 200 rupees daily on a monthly basis, your financials are not going to grow. Your wealth is not going to grow. But just imagine if you were able to save, even to start with, again, as I said, to start with 2,000 rupees or 3,000 rupees every month, right? At the end of what you will realize is the year goes away very quickly. Time flies. Before you know, the year has come to an end. And you know what? You have actually made an investment of say 24,000 rupees if you were investing 2,000 or 36,000 rupees if you're investing 3,000, for example, which is better than zero. 12 months ago, you were at zero. Now you're at 24 or 36,000 or whatever that amount may be, right? So the biggest enemy to statement number one is procrastination, right? The fear that it's not going to grow, nothing will happen. But I will tell you that you have to start and you have to start small. And the most important thing to develop in the first year of investing is a habit. Now we'll get to that later, right? Second thing, we talk about inflation. What is inflation, right? And understand the impact it has on expenses tomorrow, right? Inflation in short is the increase in price of goods and services every year. Basically, what I'm trying to say is what you paid for your spices, pulses, and vegetables last 3 years back is, 3 years back, it was more than what it was 3 years back. Last year, it was more than what it was 2 years back. And this year, it is more than what it was last year, right? So inflation means the cost of things that you buy on a daily basis keeps moving up. So, while you are working and you are earning, you get a salary increase. Your FD, let's say you're invested in FDs, your FDs grow, right? The question you need to ask yourself is my increase in salary or is my growth in FDs covering inflation, right? On an average, you can, as a thumb rule, you could say, the inflation in India is about 6 to 7% every year. So what you need to see is your FD or is your salary for that case growing by more than 6 to 7 per year so that you're covering the inflation cost, right? What you were able to buy last year, are you able to buy it this year, right? You will need more money to buy the same quantity of goods every year. Right? And the third basic aspect of investing, which I would like to talk about and introduce to you, is compounding, right? And compounding is, as Albert Einstein has said, compounding is the eighth wonder of the world. So a lot of people may have heard that, but this next statement, not a lot of people have heard him say, right? Those who understand it, earn it. Those who don't, pay it. And what does he mean by this, right? The important aspect is if you believe in the power of compounding and then you invest so that your money starts compounding, over time, you will earn it. Those who don't and don't believe in it, don't start early, don't start investing, they will pay it because their money will not grow in the way it should grow. On the right side, I have a sample calculator which says that, okay, if you had invested a certain amount of money, which, over a couple of years or 20 years, 22 to 42, 20 years, you could have gotten a return which is more than double of what you invested, right? So compounding, the important part that you need to think about compounding is that compounding needs time to bear fruit. So if you start investing, let's say you set up a monthly investment plan, and if you start monitoring it on a weekly, monthly basis, for the first 2, 3, 4 years, you won't find much of an impact. You say, oh, what's happening, right? Jaideep or someone else spoke about compounding, but nothing really happened, right? Compounding takes time. It's after that fourth, it's when you reach that fourth year, the fifth year, the sixth year, and you've been investing regularly. That's when the money really starts multiplying. And that's where you want to be. Compounding takes time. And another important thing to remember is that time in the market is more important than timing the market. And what I'm trying to say is, people will try to tell you, hey, the market's gone down, it's a good time to invest. Or, hey, the market's going up, it's a bad time to invest. And what studies have shown that because people try to time the market or try to enter the market when it's either too low, or try to exit when it's too high, they actually lose out more than trying to be consistent. The most important aspect of investing, which I would like to share with you, is be consistent about your investing. Be consistent about the time that you spend in the market compared to the time that trying to time what investments you need to make. And finally, the third thing that you need to think about is rules to enable power of compounding. Start early. That's the most important aspect. Begin early in your journey. You might end up making a couple of mistakes. Making those mistakes earlier on is much easier to deal with than making those mistakes later on in life. So start early. Be disciplined about the investing that you do, right? It's very important to say that, that every month I'll take a small chunk of money, I'll commit to that investment on a year-to-year basis, and then continue my journey accordingly, and be patient. Okay. I hope I'm not going too fast, and people can understand what I'm trying to say.
Next. You are not there, Jaideep, but there are few questions in the chat. I am sure that you will answer it a little later. There are 3 things. Do you want to take it now, or you want to take it later?
Sure. Let's. Why don't I take a short pause and answer these questions. So questions I have from Miss Uma is, sometimes income does not follow a regular pattern like a salary. Yes, especially for freelance educators. At times there are months with zero income. Great question, right? So how does a freelancer in your case plan for money, plan for monthly investments? Yes, in that case, it does become hard to have the discipline for a monthly investment. But what you can do is say that, I'm sure you have some sort of projections to say that, these are typically months where I earn some money, and these are typically months where I don't. So in the months that you are able to earn money, can you start by taking a small amount of money, whether it's like maybe it's even 10%, and saying, you know what, I will commit to investing 10% of what I earn in a month towards an investment, even if it's not regular, right? Then the more important aspect is, are you starting early enough, and are you keeping it simple? I'll come to the simple part much later, but then you meet the aspect of, am I starting early enough, right? And if you are able to meet that aspect, then it's a good start that you have taken. Another question which I have from Miss Bhuvaneshwari is that, what should be the proportion of investment? Good question. Let me take this a little bit later, because I think I need to explain a couple of more things before I get into the proportion. And I have another slide which kind of deals with it. Another question which I have from an anonymous person: what should be the portfolio in terms of percentage of FD, MF, and other products? Again, I will take this question a little bit later. I have a suggestion or a recommendation for you to follow. Okay, so let me close this. Let me go back. Sorry. Just give me a second, please. Sorry about that.
Yeah, no issues.
gone through inflation. We went through compounding. Okay,
Yeah.
so here we are. Sorry about that. Basics of investing. So now I've spoken about basics. Let me talk about some of the products, right? And everyone has this question: what are the products that I can invest in? And we spoke about it earlier in the first slide too, right? So to a large extent, I would divide products that you can invest into 5 categories. There's equity, debt, savings, commodities, and I'm going to talk about crypto because I know a lot of you have questions about crypto. So I'm going to put it as another product that you can invest in. I will share my personal view about crypto and what it means. I will get to it. So equity, what does equity mean, right? I mean, when you're talking about equity, it's basically stocks. Nowadays, you hear a lot about the ability to invest in international funds like a Google or an Apple or a Tesla. So those are international funds. Of course, there are mutual funds, which are equity-based mutual funds. Then there is something called ETFs and index funds. And then, of course, you have your NPS, PPF, your NSCs, the products which are typically out there. When you talk about debt, there's something called bonds. There's something called there's something called government securities. There are debt-based mutual funds, and then there are loans. When I talk about savings, cash is the biggest saving instrument that are out there. And then all the types of bank accounts that you have, your checking account, your savings account, your fixed deposit. Fixed deposit also is like a debt, but it's also like a savings for you. Commodities. What are commodities? Gold, silver is a commodity. Copper, platinum, a commodity. You also get commodity-based mutual funds, which you can invest in. Oil is a commodity. And I would have liked to put real estate as another asset class or another product that you can invest in. For now, just for simplicity, I put real estate in this bucket. And then the last part is crypto. And in crypto, as you know, as you may have heard, there are thousands and thousands of products. There's Bitcoin, there's Ethereum, there's NFTs. There are lots of other products, especially the younger generation is talking a lot about them. So at a very broad level, and at a very simplistic level, these are the investment products that you can invest in. So when you build a portfolio or when you build a basket of investments that you want to invest in, one important aspect to remember is to diversify, right? You shouldn't be putting all your eggs in one basket. So all your money should not go only in equity. All your money should not go only in FD. So right now, probably a lot of you have all your money in FDs and checking account or saving accounts. So you need to diversify your portfolio because in time, right, over time, some things will do well during some time and some things will not do very well. So what you need to do is balance it out. And how do you do that? I will get to a little bit later. Right. My final thing, I want to talk about crypto. Sounds very exciting. Sounds very, something that you would like to do, something which everyone is doing, something where you think you can earn a quick buck. But I will come back to 2 basic things. One basic fundamental of investing is don't invest in a product you do not understand. So if I asked any of you, what is a Bitcoin? What is Ethereum? What is crypto? If you cannot answer that question, don't invest in it. Secondly, it's very, very volatile, right? So it can go up very fast. It can go down very fast. Are you comfortable enough to take that risk? Is something which you need to ask yourself. And thirdly, I would say right now, markets are bad. And if you look at Bitcoin, Bitcoin is in a terrible state. So if you had invested last year, you would have probably been in a very bad situation today. So it's a very, very risky product and something you need to think about. So, but there are a lot of people who are still very keen on doing crypto, right? So my advice to them would be, if you look at your entire portfolio, I would say of money that you have, which you're willing to invest, I would say take 5% of that money, right? Label that money as gambling money, right? Money that you don't care about, which you can, like, literally, if I were to ask you, you can put it on fire and throw it away. Take that 5% money, that gambling money, and put it in crypto, right? Because of the uncertainty that it brings. Everything else, you invest in some of these other products that I have presented out here. Okay. We go to the next slide. Okay. Next, I will talk about mutual funds. Again, the platform that we have promotes mutual funds, helps you invest in goals through mutual funds. So let me talk a little bit about mutual funds. Every one of you, I hope, has heard this statement, mutual funds sahi hai, right? If you watch IPL, or if you watch the TV, or someone in your house watches IPL, the industry has flooded the TV with this method, with this statement called mutual funds sahi hai, right? But have you ever asked, some of you may have the questions, mutual funds kya hai, right? I will not get into the details there because it's a much longer story. But if you were to ask me, mutual funds sahi kyun hai, right? That's the thing I want to answer. So why mutual funds are better? One, mutual funds will give you better returns than savings and FDs, right? So when I talk about diversifying your portfolio and putting your money in different baskets, this is one basket you should definitely think about. Second, mutual fund, the way it's structured, it's managed by fund experts, right? So the difference between investing in stocks and the difference between investing in mutual funds, maybe I should just give a quick view on what a mutual fund is. So mutual fund is a collection, is a pool of money which you give to a fund manager, and you mutually agree to tell the fund manager that, hey, fund manager, you invest on our behalf, right? And you decide where to invest, how to invest, and we'll give you permission, right? So it's a fund because it's a collection of money that's pooled together and distributed into numerous stocks. And it's mutual because you are mutually giving consent, because thousands of people can invest in it. You're mutually giving consent to a fund manager to invest for you. Okay. So coming back to the basics, the difference between investing in stocks and investing in a mutual fund is when you invest in a stock, you have to buy the stock. You have to decide what proportion to, if you buy multiple stocks, what proportion to buy them in, how much to invest, when to exit, what is a good stock, have you done the research and stuff like that. Whereas a mutual fund is managed by someone. You just invest in a fund, the fund manager does everything else, right? Thirdly, mutual fund is best suited for investors and not traders. What's the difference? A trader is someone who buys stock and is looking for a short-term gain or a loss, right? An investor is someone who thinks long-term, who wants to think about money that they want to use 3 years, 5 years, 7 years down the road, right? So mutual fund is better suited for investors, and I'm hoping a lot of you are investors and traders. In your day-to-day job, you cannot follow the market, so you don't want to be a trader. Fourth one, with the help of mutual funds, you can diversify your investments. You can take a mix of equity, debt, commodities, gold, and other products that you can have, which when you invest through stocks, you cannot do. Fifth one, you can automate your mutual funds through an automated monthly investment called SIP. Very easy to set up, very easy to use. Invest and forget, right? That's the most important aspect when you're investing for the long term. Sixth, you can save taxes. There is a particular type of mutual fund which you can claim for tax deductions, which are eligible for tax deductions. All of you probably many of you probably fill out a tax declaration form at the beginning of the year, and at the end of the year, you need to kind of give the proof for that. So there is a type of mutual fund which fits into this. And finally, mutual funds are regulated by SEBI, which is the Securities and Exchange Board of India. So they cannot cheat you to a large extent. They cannot cheat you because they're very regulated industry. Okay. Next thing which I want to talk about. So I've spoken about products that you can invest in. I've spoken a little bit about mutual funds and why they're important. But very importantly, what is the end game of investing, right? Why do you want to invest? You need to answer that question for it. What is the goal that you have, right? And for a lot of people, there is a new concept which is popular in the industry, which is called FIRE. And FIRE stands for Financially Independent, Retire Early. And I hope and I'm sure that a lot of you want to retire financially independent. You don't want to be dependent on whether it's your children, whether it's your family. You want to be able to retire comfortably and know that you have enough money to take care of yourself, right? So financial independence allows you time to pursue whatever you truly passion, right? And while money doesn't grow on trees, it can grow when you save and invest wisely, right? So you can reach that FIRE stage of the financial independence and retire early when you're thinking about money wisely. Again, I'm coming back to think about money very wisely, right? So as we all know, there are two ways to make money. One is you work for your money, that is you take a job, or you have a salary, or you are freelancing, whatever it may be, or or you make the money work for you, and let's say, and you make the money work for you. So how do you make the money work for you? That is through investing in the right products, investing in the right mix of products, so that your risk is balanced across the products that you would invest in. Okay, so far, may I continue? Or are there some questions?
Yes, Jaideep, but there are a few questions. I think, once you complete the session, we can take it across. Educators are, coming up with a lot of questions.
Okay, let's do that.
Yeah.
Let me continue. Okay, so I've spoken about, products. I've spoken about investing. One of the things which I mentioned right in the beginning is habit, right? And that's for those of you who are new to investing, who are starting the journey. I think the most important part is setting your habit, and setting a habit will help you get towards financial independence, right? So what are some habits that you can think about? Save and invest before spending. So what I generally recommend to a lot of my clients who come and ask me, how should I start investing? How should I start saving? So I say, okay, the way to think about it very simply is, let's say you earn 100 rupees. The first thing you want to figure out is, what are my fixed, my monthly expenses, or my loans, or my EMIs that I need to pay off, right? Let's say, for an argument's sake, that's 40 rupees. So you have 60 rupees, 60% of your money left. Out of that 60% of your money, before you earmark money for spending, take a call and say, 5% of that money I will always invest every month, and I will learn to survive in 55%, right? If you are able to build that habit, so you're saving and investing before spending, small amount, that's a good habit to set, right? Second thing, start investing early. If you want to take advantage of the compounding effect of money, you have to start early, right? Third, avoid or repay all your costly debt, right? Debt is what, credit cards or whatever debt may be. Try to pay the most costliest debt out first, and then come down the ladder and start paying off the less costly debt, because the costliest debt obviously has the largest interest rate which you need to pay. Identify all your income sources. So when you're doing your planning, you need to understand that, what are the sources of income that I have. So for example, if you are teachers, is teaching the only source of income, or is there some other source of income? Maybe some of you have some property, maybe some of you have some other source that you can think of. What are they? Try not to be an impulsive buyer. Happens very naturally, but if you want to be an impulsive buyer, remember, be that impulsive buyer in that 55% which you have. Don't be an impulsive buyer for that 5% that you have committed to save and invest, right? Set smart goals, goals that are actionable, that are measurable, that are time bound, that are specific. There's a whole definition behind smart. Next, take advantage of registered financial advisor. There are a lot of advisors out there. A lot of them are I would say fly-by night advisors. Try to find someone who has an established history. Try to find someone who comes to you through a strong recommendation. But there are advisors out there who are not biased. You need to just search for them. And as I said, lastly, I'll repeat, understand compounding. Compounding effect has a huge effect on how you invest. Okay. So thought about investing, thought about everything. Now, I've given you some basics of what to think about. Now it's time to think about goals, right? Because when you start thinking about where you should invest, typically you'll have a goal in mind. One of the goals that everyone has is just setting up an emergency fund, right? That's the first goal which you should probably think about. Rule of thumb is, can you put aside about 3 to 6 months of your take-home salary or whatever you earn as an emergency fund, which can take care of medical expenses or unexpected life expenses that may come to you at any point in time, right? Then of course you may want to think about retirement, and those who are not married, you may want to think about marriage. Maybe for a lot of you, your parents take care of your marriage, but can you contribute to it? Can you have a little contribution towards the honeymoon that you take with your spouse, right? Or if you have children, have you started thinking about your child's education? Can you start that process? Or do you know where your family's investments towards your child education is going, right? So let's take another example of a customer that I had who again fit into that whole child education aspect. Abhishek, 40 years old, he's a small business owner, right? So then again, it does not have a consistent salary, depends on how the business goes. Sometimes business is up, sometimes business is down. He's got a son, Yash. Abhishek luckily understood investing early enough, right? And he set up a habit. So what he did was he set up a goal, a long-term goal for his son Yash, right? So the right things that he did, and so when he came to us and he showed us his profile, I was very happy to actually have a customer like him come to me, because what he was able to do is, one, establish an early habit of investing. Second one, he secured himself for his family. So he set up his insurance. He had all his insurances in place. He got his family insured, so he knows everyone is taken care of. Third important aspect is plan the future with the family, right? Very often, again, as I said, if you're in a situation where you and your spouse is investing for you, or your father is investing for you, or someone in your family is investing for you, and you said, I don't understand this, I don't know, what's going on. It's very important, even as a woman, to really be involved in that investing. At least you know what is happening, and at least you know what are the products that are being invested, and where it's growing, right? And lastly, of course, what Abhishek did correctly was he set his investments in place and started tracking them. He didn't get over obsessive about them, but basically he just knew what was being invested, where it was being invested, and he was able to share that with his family, so his family knew where that money was growing, right? So if I were to come up with a some simple thumb rule and checklist, right, as I said, the three things that he did right was he secured himself first. And what I mean by that, he set up, he either set up a term life insurance. Some of you may have invested in ULIPs, for example. He set up his health insurance. So if you are employed, maybe your employer gives you an insurance, but if you should always have a private insurance, your own insurance of your own, right? So secure yourself first and set up small emergency fund. Secure yourself first. Second one, plan for and with your family, right? Let your family know what is going on, be involved, understand to whatever extent you are willing to understand. Save taxes, that's the first thing you should do. The next thing you should look at is document all your financial details, so you know what your finances are, where your money is coming, where your family's money is coming. In the case of an emergency, you know where your insurance papers are, you know where your other bank accounts are, you know how to deal with them. And define life's goals and retirement needs, right? Then the last plan is, once you've planned with your family, you define your goals, right? And then the final thing is invest and track, right? Prioritize. So when you're investing and tracking, again, as I mentioned before, prioritize paying off high interest debts and loans. Start with small investments, right? You are building a habit. You are trying to understand how investments works. You don't know how it works. You don't know whether it will work for you or not. So start small, but start small, start early, be consistent, and track and monitor every 6 to 12 months, right? Before you build your financial plan, again, one of the things that I mentioned is documenting your financial status as a family, right? Very, very important step. This is a very tedious step, but it's very important for you to sit down with your family, your spouse, your father in that case, or whoever else is investing for you, and document everything that is out there. There have been numerous cases which you may have read, or I have read, or have come across, where spouses don't have a clue as to where the money is being investing, and then the breadwinner in the family passes away for whatever reason it may be, right? And there is no information that the spouse actually knows as to where the money's been invested, whether there's a bank account, whether there's a stock, whether there's a mutual fund, whether there is some other gold that has been kept somewhere. They have no idea, and because they have no idea, they cannot take advantage of it, and they are left helpless, right? So know your current financial situation, know what your current and annual monthly income and expenses are. Things you and think about the things that you and your family want and need to save and invest for. So plan that out. Think of your goals, right? Then a little bit more complex thing that happens is estimate the future value of those. So for example, when we spoke about Abhishek and we spoke about him planning for his son's education, he needed to think about, okay, today's education cost is this. There is a certain aspect called inflation. Yash is going to go to school, going to go to college 15 years from now. What is it that I need? What will that value be that I need to save for? Prioritize what you think about in 3 and 4, and then plan for your goals, right? So we do have, we have built a document called a gift of legacy. You can reach out to us. I'll be happy to share it with you anytime you want, right? So, uh, so there are three basic investment needs that most people have, and I'm sure you will be able to resonate with it. You want simplicity. You don't want to get into complex products. You want it to be simple. You want certainty, right? You want that comfort factor that the money you're investing, or where you're investing, or how you're investing is safe, that your money is, the principal is safe, and that the money will grow and that you won't be cheated. And the third thing, of course, you also want is value for money, right? So if you're investing through a company or through someone, you want to make sure that that person is not cheating you. You want to make sure that you're getting the best bang for your buck and the best returns for what you're investing, right? So keeping all these in mind, think about the goals that you want to have, whether it's a short-term goal like a vacation, it's a medium-term goal like your child's education, or a long-term goal as your retirement. Put all these aspects in mind and to think about a goal. Now, one point I want to bring out here is what goal, a lot of you may ask, what goal should I have? So some of you may not have a goal in mind. It's okay not to have a goal in mind. In that case, the simplest goal in mind is to think about either retirement, saving for your retirement, or just have a goal to say that I want to build my wealth, or I want to grow wealth. Because remember one thing, there is a concept in money called, which says that money is fungible. The definition of that is, if I take out money from one pocket and put it in another pocket, the value of that money does not change. It's still the same. So if you are saving for goal A, but you actually need the money for goal B, the value of that money will not change. It will just help you organize the way you want to plan and organize the way you invest your money. Okay. Once you have decided on your goals, investing in goals or investing actually can be quite an easy process. It's 5 steps that can take no more than 5 minutes. You sign up on a platform, or you sign up with an investor or an advisor who you trust. You should do a risk profile with them. And I'll talk about risk profile quickly in the next few slides, which basically helps you understand, what kind of risk you can take. There is a process called KYC, which everyone needs to do. If you haven't done it before, please do it. It's something which is mandatory before you start investing. You can set up a mandate. It's called a bank mandate, which basically allows you to set up a monthly regular investing, create a goal, and start investing. All this process, if you do it on a good platform, should take no more than 5 minutes. Okay. Let me talk quickly about risk. And I know I'm talking a lot. So it's very important for you to understand the risk before you make choices. So there are 2 external risks to consider. One is a market risk and a time-based risk. Time-based risk basically equates into your compounding effect, right? And what I'm saying is, if you were to invest 5,000 for 20 years, and let's say you started 10 years later and invested 10,000 for 10 years, that 5,000 which you've invested for 20 years will grow much faster and much larger than the 10,000 you've invested only for 10 years. Okay. So the time-based risk is, are you starting early in your life or are you starting late in your life? Market-based risk is the risk that you see in the market today. 2021 was a fabulous year for investments. People made a lot of money, those who invested their money in the market. But 22 has been terrible. Russian war with Ukraine has crashed the market. The market's really down. Everyone's investments are in the red, right? But these cycles will continue to happen. So once you understand your own risk, you'll realize that if you go through a cycle, and especially a down cycle, and you're able to survive it, you'll really understand what investing means. And the 2 other internal risks that you need to understand is your risk appetite and risk tolerance. What is risk appetite? Is basically the overall risk you are willing to take across all your goals, right? And when you do that, you will say, you'll get a sense of how much risk you're willing to take towards your investments. And I'll talk about it in the next slide. Your risk tolerance is the risk you're willing to take for a particular goal. And why I want to stress here is that Your risk tolerance can be different from your risk appetite. Okay. So when you're planning your goals, match your risk with your goal. Okay. Very typically, when you are thinking about goals, and as you said, we will come to the portfolio here. You'll either want to invest like an aggressive investor, invest like a balanced investor, or invest like a conservative investor. That's your risk appetite. But when you set a goal, your goal can have a different risk. Again, it at a very simplistic level, you can say, I want to invest very aggressively in a goal, or be balanced in my goal, or be conservative. So remember, there's a difference between the two, and you can choose to invest in a particular style based on the goal that you set up. Okay. So if I were to think about investing and how I would build my portfolio, if you are aggressive, if you're willing to take risk, if you are willing to invest for a long term, I would probably put more of my money in equity based products, because they are higher risk, but they are higher reward. If I'm a balanced investor, I would do kind of like a 50-50 kind of mix, or somewhere between 40 to 60% equity, because I want my principal to be reserved. And then if I was very conservative, I would invest more in debt, more in fixed deposits or any other debt products, and put a little bit of equity, so that there is some risk that I'm willing to take, but at an overall level, I'm being conservative about my growth. Okay. So there is a very famous person in our industry, Mr. John Bogle. Not sure if many of you have heard of him, but he's the founder of Vanguard. He's considered the father of passive investing or index funds. Basically, what he has to say here is something I want to leave with you. Investing is not nearly as difficult as it looks. Successful investing involves doing few things right and avoiding serious mistakes. So when you start your journey in investing, keep things simple, keep it very easy, invest in very few products, and monitor and understand what you are doing. Right. Finally, I'll just take 30 seconds to talk about Glide. We are an investment portal. We basically distribute mutual funds across all the mutual fund houses. We are available on Android, iOS, and the web. We have a customer service team, which you can reach out to on WhatsApp, phone, or chatbot. And if you want to speak to any of our advisors, we request you to register on our app and set up an advisory meet, and more than happy to have you chat with them. I'm happy to speak to some of you if you would like to do that on a one-on-one basis. Finally, the most important factor when you're thinking about money, as I said in the beginning, right? Why should you trust us with your money? So, so one is data security. We use industry grade security and privacy for all the data that we have on our system. Our portfolios that we have built are based on Nobel Prize winning research based portfolios. We have a research team which does a lot of research and back calculations to figure out what's the best mix for you to invest in. We are backed by the Motilal Oswal Group. Not sure if you've heard of them, but they're one of the big financial service houses based out of Mumbai. They have 30 plus years of helping customers build their wealth. And fourthly, we will give you regular reports and dashboards, which will help you and your family track what you're investing, how the investment is growing and where it's growing, and then also give you the opportunity to talk to an advisor to talk about your overall investments, right? Finally, just some recommended reading for those who want to read a little bit more about it. The first book which I will recommend is this book by this author called Morgan Housel, called The Psychology of Money. Again, I'm coming back to the first most important thing is how you think about money, right? How your family thinks about money. Read this book, highly recommend it. And if you can, go to YouTube, find some videos of Mr. Morgan Housel, see how simply he talks, how he talks about money. It needs to be simple. Second book is a book by Monica Halan, a very famous author in this space, Let's Talk Money. I would again recommend you to go to the bookstore and buy it. Very simply written in a very simple language, made for India. Okay, she's an Indian author. And thirdly, on our website, we have a little booklet which you can download for free, which is called Investing Simplified, right? So that's all I have. I know I've taken up a lot of time, and I actually want to leave it open to a lot of questions. You can reach us on our website. You can reach us by email. There's a WhatsApp channel. I will share this presentation for Dr. Malti to distribute it to you, and happy to connect with you and answer any questions that you have. So that's all I had for today, and happy to take questions now, Dr. Malti. I know there were some questions which some of the investors had, so I can take those, or I can take the new questions which are there on this list here today.
No, there are a few questions. Thank you, Jaideep, for the wonderful presentation. I have to thank you for that because you really made it simple. The term investment always scares us. And then we have been talking about financial literacy, introducing financial literacy to children. And what I felt is I need to empower my educators first on investments and about finance, the kind of a fear that we have towards finance. I really love the way you presented, and then also the the recommendations that you have given for reading, because the love for money, we all have that, but money always comes with the fear factor. I think that one important thing which you nailed it, saying that you start loving money as you start loving your life. Prioritize how much ever little your income is. I know that we don't earn in big numbers, but whatever we have, start investing, start saving a bit of it, as he rightly said. I think it's time for us to take few important questions, because somebody has asked to start with. You mentioned about starting early. What if somebody starts late? Maybe somebody starting at 40. Can they do it?
So I would say, if yes, you can, and yes, you should. You should start investing the day you learn about how to invest, right? Because you can't do anything about the time that you've lost, right? So, but why procrastinate? Again, as I said, why procrastinate even further, right? Start today, start simple, start early. Yes, maybe if you start later in your life, the depending on the goal you have, or depending on where you want to reach with your investments, you may need to invest a little bit more, right, than what you would have to do if you had started early. But it's never too late to start early. And why it's never too late? Because prior to that, you didn't know that you should start, right? So what you didn't know, you can't do anything about.
Oh, so there is a question again, how, whether it is mutual funds or gold, and then, is it physical gold or the digital gold? There is a question.
In mutual funds, the gold is digital gold. Okay. You actually don't get the physical conversion. The mutual fund house actually takes care of the gold. So you don't have to worry about saving the gold in a bank or anything of that sort. It's managed by the fund manager. It's not physical gold.
No, is it good? Which one is better? Their question is, which one is better? Is it digital or physical gold? Which is better?
Oh, okay. Sorry, I misheard that question. So there are pros and cons to both. Okay. I would say the advantage of physical gold, and for many people, gold is very precious to them. There's an emotional feeling to it, right? And if you don't have that gold, you won't have that emotional connect, right? But to a lot of people, what you care more about is how the gold grows and where it grows, right? So when you are investing in gold through a mutual fund, the actual expense of owning that gold and seeing that gold grow will be much more than actually owning the physical gold, right? In the physical gold, somewhere you'll spend it on conversion, you'll do something with it. You'll have that fear factor of where do I store that gold and how do I store that gold? So where gold is concerned, my personal take on this is, yes, have some gold with yourself to meet your emotional needs, right? But for the rest of it, you can invest some of it in mutual funds. You don't need to keep gold bars at home because you want to invest in gold. If you are keeping gold bars of that sort, then you're better off in mutual funds. And remember one thing, because gold has a very emotional aspect to it, it becomes very difficult for you to sell that gold in the case of an emergency, because maybe you have a gold chain or something of that. There's an emotional value attached to it. Versus when you have a mutual fund, there's no emotional value attached to it, right? If you need to sell it, you will sell it.
Okay, so there's another question which actually has come on my WhatsApp. What has been asked is, it is easy, whenever there is an emergency, I know there is physical cash in the bank, so I can withdraw from the FD. Supposing if it is on mutual fund, will it give me a loss, if I have to break the mutual fund, and how long the process takes? Because as a common person, my fears are always there. I do not know how soon it is to get the money back.
Okay, very good question. So a typical mutual fund, when you invest in a mutual fund, you can sell the mutual fund partially or completely at any point in time. Okay. except for something called an ELSS fund, which is a tax saving fund. Okay, an ELSS fund, when you invest in it, there's a 3-year lock-in, so you can't sell that. But let's say you're investing in a fund other than the ELSS fund, you can sell it partially or completely at any point in time, firstly. Secondly, typically in mutual funds, there is a 2-day or a 3-day conversion, right? So what it means is, depending on when I sell it, the money will reach my bank account within 2 to 4 days, depending on the type of fund, right? So if you are in that emergency situation and you need that bank account and you need that money, that's why I said, when you build an emergency fund, you can either keep it in your bank account in an FD, or you can invest in a fund. So there is a certain category of mutual fund, there's a certain type of mutual funds where there is now a feature called Instar Redemption. Okay, and what that mutual fund basically allows you to do is sell the fund and get the money back into your bank account in 30 minutes. Okay, I've tried it. We have that on our platform, and the money actually comes to your bank account in 2 minutes, not 30. The industry promises 30. The AMC gives it actually to you in 2 minutes. So yes, you should not put all your money in mutual funds. Again, I said, keep some money in your bank account, keep a small savings in your bank account. That's your emergency. And then for the rest of it, put it into mutual funds.
Excellent. So Pratibha Santanakrishnan has a question. As a startup, we have invested in all the modes that you have said. Recently, we have started investing in share in Motilal Oswal, but leading companies share like Adani, LIC, and then, she mentions about all those things. Can you say whether there will be an upcycle in the near future?
Sorry, your voice was breaking. Can you repeat the last question, please? Can you say?
No, she says that she has invested in all the modes that you have already mentioned. And then, now leading company share like, Adani and then LIC and Infosys all have a down cycle now. Right. Can you say where there will be upcycle in the future?
If I was God, I would tell you. But answer is no. Nobody can tell you when the down cycle will end. Nobody can tell you when the upcycle will start. I'll throw a simple example to you. Tomorrow, if Russia decides to end the war, the market will recover, right? But do you know if Russia is going to decide to end the war, right? This war could continue for the next 3 months. So you don't know what's going to happen. Somewhere, some Mr. Modi could go and, get the two leaders to meet. So meet and, have peace out there. Market will change. Market changes very rapidly nowadays, right? So there's no guarantee when the market where it will fall, where it will start. So I'd love to be God and tell you, but I can't.
Thank you, Jaideep. Thank you. Is there any other questions, dear educators, that you have who have been watching? Is investing when the market is down wise?
Okay, good question. So, there's a saying in the market which says buy low, sell high, right? But do you know when the market is going to stop being low? No. Do you know when the market is going to recover? No, right? Do you know if you wait because you think you know when the market is going to reach its bottom and the market suddenly turns, you'll have missed that whole curve, right? So when you talk about investing, right, and you're doing regular investments, this is a very good, right now, if you have the money and you have an outlook for at least 3 years, minimum 3 years, this is a very good time to invest. Why? Because you're actually catching the market at various down cycles, right? And this is the best time to invest, because if you try to catch the market at the up cycle, you'd always be investing when the market is expensive. Right now, let it go down. Your money your portfolio will look in the red very often, right? But the point is you're catching the money at the time when it's going down, so that when the up cycle comes, you've invested at a very cheap price.
Thank you, Jaideep. Thank you for taking time. Dear educators, I'm sure that, most of our questions and doubts are answered because as I mentioned earlier, finance is something, there is some question. What should be the portfolio in terms of percentage and FD? I think the same question is coming back. Right. FD, MF and other products. I think we should.
Let me take that really quickly, right? Mm-hmm. So again, as I said, when you look at your portfolio, you need to think of your risk appetite, right? Your overall portfolio, you need to look at your risk appetite. And let's take, for example, you are an aggressive investor. So I would say, put about 80% of your money in equity, 20% in debt, right? So FD is a debt instrument. So that 20% of your overall investment comes into the debt portion. The remaining portion will be in equity products. So in equity products, you can invest in stocks if you want of your own. You can invest in mutual funds, or you can find other equity products to do. In debt, you can invest. There are debt mutual funds also, and there's FT also. So that's how you need to think about it, right? There's no right or wrong answer, and there's never be a right or wrong answer, right? The idea is that you need to understand your risk profile, and you need to see where your portfolio will grow.
Thank you. That's wonderful. Friday evening, Friday is the day dedicated to Goddess Lakshmi, and then this evening time, let Goddess Lakshmi enter all our homes. Let's start it small. If we haven't started it earlier, it is better late than never. That's what we all feel. I think with this session, I'm sure all of all of us are attuned with the words. At least our ears are attuned with the words. What is equity? What is debt? What are mutual funds? How do we invest? At least investment has got into our head. That's what I believe in. Because when we need to give something to the children, we need to persist. When we need to educate our children on wealth creation or financial literacy, I think we need to know more about it, and we need to be living examples. I'm sure this session would have empowered each one of you. We are definitely coming back with a lot of interesting sessions. You can reach out to us and write to us what kind of a sessions you definitely need to listen to. What kind of speakers would you like to listen to, dear educators? Thank you for joining in. I really take this opportunity to thank Mr. Jaydeep Tibrewala again. I'm going to share your presentation and your contact details of Glide Investment with our educators, whoever has joined us today, which will help each one of you, as he rightly said, keep it simple. Let's keep it simple. Let's keep life simple and then easy. And then let's create wealth. Creating wealth is definitely not a Herculean task. Where there is a will, there is a way. All of us can multiply wealth, and let there be abundant wealth in all our lives. Thank you so much for joining us. Thank you. Thank you, Jaydeep.
Thank you. Thank you so much.